Juané Schreuder. I'm a chartered accountant and registered auditor, and I am also the chairperson of the SAICA AGC, or Assurance Guidance Committee. The purpose of today's session is to take you through a technical overview of the new standard on how to audit accounting estimates. We refer to it as ISA 540 revised. Remember that this session is just the start in, I almost want to call it a series or in a group of projects that we have in place. We'll talk about it a little bit later on, but this is not just a standalone item. So you will probably be encouraged after today's session to go and look at the other options or the alternatives to supplement today's session. First of all, in line with everything else that SAICA is doing in terms of restoring the confidence in the profession, a general ethics message before we get started. So everything we do as chartered accountants, in business, in practice, and of course, especially when we are then auditing these accounting estimates, needs to be engendering trust. And probably one of the most important things that comes in with 540 specifically is professional skepticism. It is exceptionally important because accounting estimates can be so easily susceptible to misstatements, intentionally or unintentionally. So, and of course, then when you get intentional misstatements, you get management bias, you get fraud. So we want to make sure that we are really applying our professional judgment, that we really are skeptical, and of course with that, everything that is included in the Code of Conduct. Then if we have a look at the agenda, so just to show you the complete package that we've put together for you. Of course, today's session, we're going to talk about the standard itself and the technical overview, the requirements of the standard. What we are planning then to happen in line with this or in combination with the session is then a seminar which will then incorporate firstly the accounting requirements or the financial reporting framework, IFRS for SME, where we are looking at a bunch of the estimates or accounting estimates that the preparer of the financial statements need to make in terms of preparing the financial statements. So that's the accounting requirements. On that same day, with the same seminar, we will then incorporate practical examples. We're putting together one big case study where we're going to look at a bunch of these as estimates and see how do we then take these technical requirements that we're looking at today and actually then apply it when we are auditing a real entity and a real entity's estimates. So that should then give you a very, very good practical way of taking this forward to when you need to go and implement ISA 540 revised very soon. Let's jump straight into those requirements and see what is required. First of all, ISA 540 was approved in June 2018 internationally. IRBA locally approved the same standard in November 2018. On the slide, you've got that little hyperlink where you can go and actually download the standard itself. Firstly, or as a reminder, effective for audits of financial statement periods that begin on or after 15 December 2019. So yes, it is for the financial statement period that starts on or after 15 December. Therefore, your first real audit for an annual period, so not a 6-month period, is then expected to be 31 December 2020 year end. So just a little bit longer than a year from today when we're recording, of course. But of course, this is going to become more and more important as we get closer to implementation day. And please, by all means, early adoption is permissible and actually encouraged. I know of more than one audit methodology that is already working at early adopting this, should the users want to. A quick overview then of ISA 540. Just quickly, we're obviously going to talk about this in a bit more detail. The first thing that is a significant change in the standard compared to the old ISA 540 or the extant one that we are currently using is an enhanced risk assessment. Then we need to have work effort that is actually focused on the objectives of the standard. So everything we're doing is focused on those objectives. Separate assessment for inherent risk and control risk, now not a new requirement as such in that the standards have always allowed for this, but now you have to separately assess inherent risk and control risk when you are assessing the risk of material misstatement for accounting estimates. The concept of a spectrum of inherent risk is then also included in the standard. It is not necessarily a new concept, but it is now part of what 540 requires, and there's also an appendix that lists inherent risk factors that the auditor should consider. So these have probably also always been around, you might have thought of them and stuff, but now it's written into the standard specifically mentioning these things and how you should consider them. Then specific material that shows you how the standard is scalable, a number of paragraphs that actually shows you this is when it becomes more complex or higher estimation uncertainty, or less complex, not so much estimation uncertainty, and all the various inherent risk factors that is then applied there. There's also emphasis on the importance of applying the appropriate professional skepticism. We mentioned this just a while ago, but quite a number of instances where it then actually brings that out for us as well. Disclosure requirements, or then especially saying how the auditor should actually then consider the disclosures of these accounting estimates. And maybe something to mention there specifically, that the requirements now is that the auditor should consider whether those disclosures are reasonable. Right, so that's basically your conclusion that you need to get to. So in terms of the disclosure requirements, then definitely intentional effort there for the auditor to consider. New requirements in terms of the standards that require communication with those charged with governance. So specific requirements coming in there, we'll obviously mention them later on, but that is something that I think is quite a good enhancement to the standard. And then enhanced application material, lots and lots and lots and lots of application material. And I'll obviously refer to them here and there. You may need to go and look at some of that stuff when you get to the practical application yourself, but very, very detailed application material and very helpful. Right, then professional skepticism. We mentioned it now already a few times. Let's just first of all, before we jump into the requirements, see how does ISA 540 Revise actually bring that in. First of all, the further audit procedures that need to be designed must be in such a manner that it is not biased towards obtaining evidence that will only corroborate what we are already expecting, and it will also not exclude evidence that's contradictory. So you really need to, almost want to say, maintain an open mind in terms of checking that you're also considering contradictory information, not specifically excluding it, not just focusing your effort on checking or confirming that, yes, management said this, yes, this is actually what it's getting to, without considering alternatives. Stronger language used in the application material to really help you and show you, listen, this is where professional skepticism comes in, this is where you need to consider it. If we specifically use the word stronger language, one point there in the standard actually refers that the auditor should challenge management in more instances. So you can see really strong language. Then in terms of focusing on management bias, specifically mentioning in the risk assessment as well as in other work, and of course in your further audit work, your further audit procedures. So definitely a focus on management bias from the auditor side, which of course is where you need to apply that professional skepticism. And then one of the, it tends to be, or it seems to me like it's a new trend that's coming in with all these new standards, is the so-called stand back provision. So one of the later requirements in the standard is then saying, right, as auditor, you need to stand back and say, right, I've done the risk assessment, I've done the further audit procedures, everything. But before I run off to the next thing, let me just stand back, let me just do an overall evaluation and see, have I met the objective of the standard? Is everything in check before I move on? So clearly, a lot of emphasis and focus on the professional skepticism concept from ISA 540. The scope of the standard itself, it basically says that the auditor's responsibilities relating to the accounting estimates, and very important, the related disclosures, is then considered in the standard. It specifically also mentions and says, listen, we're not necessarily thinking up new things that's not in the understanding the entity and risk assessment 315, that's not in the responses to your risk assessment, that's not in your audit evidence standard, etc. There's very little that's necessarily new. There's nothing that's contradictory that I can think of, but it's basically saying, let's take those requirements, let's take those principles and really just show you how they are applied in the accounting estimate audit sections. It also then includes the requirements and guidance on the evaluation of misstatements, which obviously is then also from 450, but just really giving you a little bit of guidance when applied again to accounting estimates. And we'd mentioned management bias, specifically giving you indicators of possible management bias that you need to consider. If we then look about the nature of accounting estimates, and we'll look at the definition of accounting estimates as well, but You know, accounting estimates can vary very widely in nature. You can have accounting estimates that is simple to calculate, and you can have things that are really complex. But it must be made when there are monetary amounts that cannot be directly observed. In other words, I can't check this invoice and say, yes, this is what it is. Or I don't know whether the client is actually going to pay his full account, or there's a claim against me, I don't know how much I'm going to have to pay. Those kind of things. You know, we can look at a whole bunch of examples shortly. But really, the monetary amount cannot be directly observed, so there is uncertainty about that. And so we have to obviously go and consider that. You can see you can get a whole variety of accounting estimates. This standard, this auditing standard 540 revised, applies to all accounting estimates, obviously from the auditor's perspective. So any accounting estimate you can think of. All right, so monetary amounts, or the measurement of those monetary amounts, is not observable. So you've got to go and look at what is the best estimate, and therefore the name estimate. Of course, these are subject to estimation uncertainty. Okay, so we're not sure. We need to make estimates. We need to apply judgments to a degree. It obviously they also reflect inherent limitations because we are making estimates. We don't know for sure. And the degree to which an accounting estimate is subject to this uncertainty will also vary substantially. If you have, for instance, an estimate that you need to estimate over a number of periods, the information may not be as sure or as certain as in terms of saying, listen, what is my provision for leave pay going to be? I know how many days the guys are outstanding. I can easily determine the rates. That's a lot easier, a lot less estimation uncertainty in that regard. The process of making these accounting estimates, which I want to almost interrupt myself and say, remember that the making of these accounting estimates is a management item. Okay, so the process of making this accounting estimates is the process of selecting and applying a method, using data and using assumptions, and you can already see we're going to have to audit all of those things, but using this data and these assumptions and applying the judgment in applying or in calculating the measurement. Now, obviously, there can be more complexity, there can be less complexity. How difficult is it to calculate this item? That complexity, even the subjectivity, we've spoken about the estimation uncertainty, and all those inherent risk factors that we'll talk about later on, is what makes this concept, this accounting estimate, this amount, susceptible to misstatement, and with that, of course, susceptible to material misstatement. So, applying of the method, the assumptions, the data, we need to test, we need to consider whether any of those items could be subject to material misstatement. So clearly an important part of the audit process. Some key concepts that's explained in the standard is, first of all, the separate assessment of inherent risk. All right, so as your inherent risk increases, so does the complexity, the subjectivity, all those items play a role in your inherent risk. There's references to ISO 315 and 330. We mentioned that before, so please do not forget that this standard is not in isolation. It's really just enhancing the other requirements. There's that separate assessment of the control risk, which is now a requirement. Then also probably something that you might almost say, yeah, but of course, but it's very, very clear, it's very specifically mentioned now that the audit is further procedures, so your substandard test of detail, your analytical procedures potentially, your control procedures, your test of control. All of those need to be responsive to your risk of material misstatement. Standard goes a step further and says you need to also consider the reason for your assessed risk of material misstatement. So your response needs to really talk to the reasons for the probably higher risk assessment. You've got to exercise your professional skepticism, and we've already mentioned how can I be demonstrating that professional skepticism. So one of the key concepts in there, and then of course the point that the estimate as well as its related disclosures needs to be reasonable. Of course, if it's not reasonable, it's probably misstated, and we'll need to consider everything around evaluating the misstatements. Reasonable in terms of financial reporting framework. So what is always very important is you've got to go back to what is the accounting requirements, and then once I've got the accounting requirements, then I can come and consider whether it is reasonably accounted for, reasonably disclosed. Right, so your accounting framework, your financial reporting framework, IFRS for SME, or potentially another framework, that is your first starting point. What are those requirements before you can audit whether it's reasonable or not? Okay, so if we then look at the objective of ISA 540 revised, it is very, very clear. It is to obtain sufficient and appropriate audit evidence about whether the accounting estimates as well as its related disclosures in these financial statements are reasonable in the context of the financial reporting framework. So reasonability to consider, we've got to make sure that the data and the assumptions are consistent with each other in this estimate, with other estimates, and even almost want to say in the rest of the file. Okay, we need to make sure that it takes the appropriate information into account to comply with this framework. We can also no longer just talk about adequate disclosure in the financial statement. So the auditor doesn't just say, yeah, I'm happy there's adequate disclosure. We need to actually check that these disclosures are reasonable. Right, so that, I just want to reiterate, is definitely then a new element to the objective. Right, finally we get to those definitions. So we've talked about accounting estimates, we've talked about estimation uncertainty. What is the definition? Now the definitions on this slide specifically are new or changed, slightly changed ones, but having a very definite impact on our consideration. So accounting estimates, the concept has always been there, but the new definition is that it is a monetary amount from which measurement is subject to estimation uncertainty. So can I clearly get to the amount? No. Well, if it is an amount, a monetary amount, I can't get a clear amount, then it's probably an accounting estimate when there is uncertainty about what the measurement should be. An auditor's point of estimate or an auditor's range, the definition is also changed. This is an amount or a range of amounts, respectively, that is developed by the auditor in evaluating management's point estimate. In terms of the definition of estimation uncertainty, that then refers to the susceptibility to an inherent lack of precision in measurement. So bringing in that uncertainty. So before we move on to the next definition, let's just look at about a few accounting estimates. So remember now the definition, it is a monetary amount for which measurement is subject to estimation uncertainty. So probably the first class or category of estimates that a lot of people sometimes only focus on or even forget about is fair value estimates. So there we can have things like share-based payments, anything basically at fair value like intangible assets that need to be considered for impairment, goodwill, investment property at fair value, any of those where you then consider the fair value. But then you also have all kinds of other estimates where the amount is uncertain, like for instance your provision for leave pay, your inventory obsolescence consideration, your warranty obligations, depreciation methods, useful lives, residual values. In terms of debtors or trade receivables, the provision for doubtful debt, and. So there are many estimates in terms of the accounting frameworks. Looking then at the next definition for management bias, that is really a lack of neutrality by management in preparing information. Now remember that management bias is not automatically fraud. It can just be unintentional management bias. So it is important to be aware of this, to be alert to this, but don't just run off and say, oh, fraud, the moment that you come across this lack of neutrality. So it doesn't change, or the definition has not changed, but it is important that we just are aware of this. All right. So as I mentioned, it could be unintentional, it could be intentional management bias. Just be aware of that so that when you come across this, that you can address it. If we then go to the requirements of ISA 540, we're going to obviously go into the detail, and I'm going to refer to paragraphs and examples. But what I want you to have a look at is the flowchart and the diagram that the IFAC prepared as an example or as a guide that we can work through. And I'm going to refer to the flowchart every now and again, and we're going to go step by step looking at this. So let's have a look at this flowchart. So you can see on the left hand side, there you've got the grey blocks that go from the top to the bottom, which is basically explaining your process or your audit steps, if I can mention it like that. So we start there at the top, risk assessment procedures and related activities. Then we go to identifying and assessing risks of material misstatement, responses to the assessed risks of material misstatement, disclosures, considering management bias, that stand back or overall evaluation based on the procedures performed, the written representation, and the communication. Those are the steps then that we need to consider. The blue parts all have the references to paragraphs, specific things that we need to take into account. Just looking at the first part, the risk assessment procedures, obtaining an understanding of the entity, and a lot of information about that. Performing a retrospective review. You can see the specific paragraph references there if you need to go and look at the detail. And also determining whether engagement team requires specialized skills or knowledge. And you can work through this whole diagram as we go along. So our slides will also follow the same process. You're most welcome to then follow the flow chart on the one side in conjunction with the slides that we are working through. Before we go back to the slides, two more things that I want to point out. On the right-hand side, your green blocks, you see that gray heading there, documentation, another audit step or another section to consider. Next to each of these audit steps, it then basically lists what about the section needs to be disclosed. What about this step? What about that step? And each time helping you through the process in terms of ensuring documentation requirements are also met. And then if we look about halfway through this flow chart, you see these three differently colored blocks, the light blue, the green, and the orange. And just above that, the heading that says the 3 testing approaches. So when we obviously get to the further audit procedures, then we will go into the detail of these 3 different approaches. I'm not going to go into the detail of this flow chart, but I do think it's valuable for you to just know that it is there. Again, you can follow the flow chart as we go through the slides, really just setting out the different requirements for these 3 different approaches. So those are the 2 IFAC flow charts. Please feel free to keep them next to you, one as we go through the requirements, and of course, as you go to audit your first audit and when you need to go and consider these accounting estimates. Very, very helpful guidance indeed. If we then go to the risk assessment procedures and the related activities, that first grey block actually in the flow chart, the first important requirement there is the obtaining and understanding. And there are 2 main headings, and you're probably going to say, oh yes, of course, I know this from ISO 315, obtaining an understanding of the entity and its environment, and an understanding of the entity's internal control. So not necessarily anything new. What I want to warn you about, or to be on the lookout for, is that as we go through obtaining this understanding of the client's entity, the environment, the controls, and these estimates and everything around these estimates, we need to always be careful that where the client has maybe not done stuff that they should have, that we don't move into that dangerous space of actually taking on management responsibility and going and doing the stuff for them and simply processing and fixing up their accounts. So we have to maintain that independence, and we need to consider whether the client has done the stuff or not. Yes, of course, if the client has not done an accounting estimate, or if his estimate is wrong, and we do that by following through all the requirements of the standard, by all means, we are allowed to provide feedback to the client to say, listen, your accounts are actually materially misstated, unless you are happy with, let's say, a qualified audit opinion, you need to fix the accounts, and this is the misstatement that we found, and propose a correcting journal entry to the client. I want to refer you to the SAICA guide in terms of the Section 90 application in terms of the Companies Act. And it also incorporates consideration of the code. You've got to keep all of these items in mind when you are doing work, when you are auditing sections, so that we don't start fixing the client's accounts when we are actually supposed to be auditing them. Right, so please just be aware that we don't end up doing that. All right, then when we get to understanding the entity, its environment, remember we are busy with the standard on accounting estimates. So everything listed on these requirements relates to, we need to understand the environment relating to estimates. Okay, the same thing with controls. Later on, we'll consider controls around estimates. How much work do I need to do? Well, that is already something where we need to scale it. We need to consider, what entity am I looking at? What is the nature of this entity and so forth, and basically determine the extent of procedures of understanding and the extent of further procedures and everything in terms of my auditing effort based on my judgment in saying, how complex is this entity? How much work is really necessary? Right, so let's kick off then with obtaining an understanding of the transactions, the events, the conditions in this entity that can lead to accounting estimates in the financial statements. You know, I recently read a quote that basically said that unless you understand how to prepare the accounts, you can't audit them. And this is really it. Unless you understand what accounts the client has, what the framework requirements are, you cannot actually audit it. And we've already heard that earlier on when we looked at the reasonability of the estimates in terms of the framework. So what transactions, what events, what conditions does the client have that's going to lead to accounting estimates? And then the very next bullet on the slide is actually referring to the framework and saying, what are the framework's requirements with regards to these estimates? What is the recognition criteria? Can I account for this? Can I bring it into the balance sheet or not? What is the measurement basis requirements? Do they prescribe certain models, for instance, certain assumptions, certain data? Do they prescribe certain things? An example that I want to bring in here in terms of the measurement basis, in terms of the accounting framework or the financial reporting framework, is from the financial instruments, where we need to bring in the expected credit loss model for financial instruments. So there's a measurement basis prescribed for us. Yes, of course, not all estimates have prescribed measurement basis, and that can be a good or a bad thing because obviously management then needs to decide their own one. But we've got to consider the recognition criteria, and we've got to consider the measurement requirements, which could then prescribe or not prescribe the model and so forth. So coming back to the framework. What is the presentation and disclosure requirements for this accounting estimate? We can't conclude the estimate is reasonable if we don't know what should be in there. And of course, how are any of these affected by the inherent risk factors, estimation uncertainty, subjectivity, complexity, and a few others in terms of this accounting estimate? The standard refers to regulatory factors. Now, this one here could really become a point where we're saying, oh, we don't have any of those. But remember, the standard needs to incorporate everything. So some of the examples that they have here is where maybe banks or insurance industry actually have specific maybe measurement basis that they need to use, maybe models that they need to use. And we need to understand that environment of the client in terms of that estimate to be able to audit it properly. So obviously, if you don't have a regulatory factor that prescribes the estimate, happiness, you can move along and get to the next step. We also, of course, need to understand the nature of the estimates and the related disclosures in the financials based on all of these items. What transactions, what events, what is the framework's requirements? If we then move on to the entity's internal control, we're still in the process of obtaining an understanding of this client with specific focus on the accounting estimates. Now, if you look at these points very carefully, you will probably recognize the 5 elements in terms of internal control from the COSO framework. This specific standard actually has a 6th point in there as well. So let's just look at what we need to consider here. First of all, the standard says you have to understand basically the entity's control environment. You've got to understand the oversight and the governance over the reporting process for accounting estimates. That will bring in the culture, the ethics, the director's oversight, management review, all those things, because if that does not actually operate effectively, then the information system may not actually give us what we need. The control activities relevant to the individual estimate may not actually give us what we need. Secondly, we need to consider management's approach in terms of specialized skills or knowledge. This is the additional one that's included in the standard. And that is really saying that has management considered whether they need and to what extent that they use those special skills and knowledge. And then another element, of course, the risk assessment. So how does management go about identifying the risk that these items may be incorrectly misstated? Even the fact that they need to identify how there's a new accounting estimate or there needs to be a change in the estimate, and let's include that. Of course, with that same risk assessment process, we need to consider whether there's any bias and then also the risk for any fraud in getting to these amounts in estimating these accounting estimates. Then probably the one that we're most comfortable with Is the control activities relevant to the audit? We're going to talk about that later on as well, but we've got to also consider any control activities relevant to the audit. Management's review of the outcomes of previous estimates, right? That fifth element in terms of monitoring of controls. So does management, and to what degree do they, consider the outcomes of previous year's estimates in terms of determining whether they need to amend those estimates in the current year, or even whether they need to amend their models, their assumptions, etc. In terms of understanding the information system, which was one of the elements on the previous slide, relating to these accounting estimates, we need to identify classes of transactions, events, and conditions that are significant to the financial statements. Now, this is not a new concept. ISO 315 requires exactly the same principles. So again, here we have an example where ISO 315 principles are taken and said, right, how do we apply this to accounting estimates? So you'll take the same element of you identifying significant classes of transactions, events, and conditions for normal information systems from ISO 315 and simply go and identify those significant accounting estimates and then do the following. So in terms of obtaining this information system or understanding the information system for these significant accounting estimates, we will then go and we'll identify relevant methods. What are they using? What assumptions are they using? And very often the standard also talks about significant assumptions. So you don't need to go and look at every single little bit of assumption, because often there are many assumptions. But specifically looking then at significant assumptions, the sources of data, okay, are any of these still appropriate? Do they need to change? Any. So the methods, the assumptions, or the sources of data. You've got to understand the degree of estimation uncertainty involved in this accounting estimate. We've mentioned this before, and we'll still talk lots about estimation uncertainty, but it could be that for a certain client, estimation uncertainty for the same estimate may be higher or lower than the same estimate, but in a different client or in a different industry. So you really have to understand this and apply your mind to be able to go forth. And then, of course, the range of possible measurement outcomes. So for certain estimates or for certain clients, there will only be one possible outcome, or based on the estimates that we have, based on the assumptions that we have. There may be a bigger range, there may be a smaller range, or the range may change. So we've got to understand that and the link of that to estimation uncertainty. And then, how does the client's information system address this estimation uncertainty? How does the client go at choosing a certain point estimate? How do they go and use the information system in terms of disclosing matters in the financial statements? When we get to disclosure later on, we'll mention this again, but basically the client needs to make sure that the amount disclosed in the financials is clearly identified as an estimate. So when you're looking at the financials, you should know or understand that this is an estimate. It's not just a definite amount. And then also, very important, the disclosure around the fact that there's estimation uncertainty. How does the client address the estimation uncertainty? What are the elements that can be uncertain, that can actually lead to a change in this estimate at the end of the day? Right, so that is very important. We need to understand how management has actually addressed estimation uncertainty. And the standard goes as far as saying that if management has not gone and understood the estimation uncertainty, you actually need to discuss this with them. And you need to understand how have they gone and identified alternative methods, assumptions, and so forth. And how do they actually then go about deciding again on what they have. You obviously don't want them not to consider any of these, because that is just going to make your risk of material misstatement so much higher. When we then get to scalability, now we mentioned this earlier on and we said the IAASB has really gone to a lot of trouble in terms of bringing scalability in, and there's a number of paragraphs. So let's see, what are these elements that really incorporate scalability for us as auditors? First of all, there is definite mention that the nature, the timing, as well as the extent of the audit procedures that you may be doing or may need to be doing to audit a certain accounting estimate can vary. So for certain clients, you're going to do more or less, either in terms of substantive procedures, in terms of understanding, etc., depending on this client's circumstances. So it really is a matter of professional judgment, and that you need to consider what is applicable in the circumstances. There may be certain elements that says you need to do X, Y, Z, but if that circumstance is not relevant to your client or to the estimate, then you're just not going to do that part. So your extent of work is likely to be less extensive when the entity's estimates are less affected by those inherent risk factors. Estimation uncertainty, not as complex, in other words, simple estimates, no regulatory factors like we mentioned earlier, no subjectivity or very little subjectivity, and all the other inherent risk factors. So that will probably then lead to less extensive work or different timing of doing your work. And also, when there are fewer controls relevant to the audit, that is likely going to, well, basically you're not going to be able to test controls if there aren't controls that are properly designed, or if there are fewer controls, you might need to change the nature of your work. Right, so that is very important. The processes may be uncomplicated, the information may be generated outside of the ledgers. Now that in itself can either then make it more complex or less complex, and you need to consider that. The standard specifically mentions owner-managed or instances where the owner-managers have a significant influence over the calculation or the estimation of that amount of the accounting estimate. On the one hand, if there are very few controls, the information is uncomplicated, and the owner-manager simply makes the estimate, well, that probably makes it a simpler estimate. But at the same time, there's then that risk or that possibility that there may be higher management bias. So yes, there's a pro, but there's also a con, and you need to consider all of that. All right, so the requirements from the financial reporting framework may even be simpler. That can also lead to less extensive work. If I think IFRS versus IFRS for SME, very often those have a difference. And then the significant judgments that may not be involved in your smaller entities in terms of providing for inventory obsolescence, for instance. If you have simpler products, simpler production processes, quicker turnaround of your stock even, you're not going to have to go to that extent in terms of auditing the estimates. Another point that's mentioned also in terms of scalability is that you may need to have more inquiries of management if there are less controls. So just take into account in terms of how you are going to obtain this understanding, how much work do you need to do, and what would be the nature of it. Maybe more inquiries and less documented controls and stuff like that. Right, then another part of the requirements in terms of risk assessment, if we look at the requirements flowchart, that is the middle block there that refers to a retrospective review. So ISA 540 revised specifically requires that the auditor should review, should look at either the outcome of the previous year's or the previous period's estimate. Of course, if that estimate is still ongoing, the re-estimation thereof in the current period. Why should you do this retrospective review? Well, first of all, in terms of your assessment of the risk of material misstatement for the current period, you need to know whether the previous year's period process worked. If the previous year's management's process of making the estimate worked well, and there's an indication that it's going to work this year again, fantastic. Then you can probably have an expectation that it's going to work, and you're probably going to go and use or audit that same model, that same method. But if it clearly didn't work and the client clearly got it wrong, maybe it was a high estimation uncertainty, well, then you're going to need to consider it more carefully. Why? Because just because management's estimate did not come to the exact same amount as the outcome, so let's say I provided for a certain amount of stock obsolescence and actually I had to write off a lot more, it's not as such indicative that my process wasn't working last year. It doesn't mean that my judgments were necessarily wrong last year. We'll need to investigate why was there a difference in the outcome. But it is already a starting point to help us to identify when a management's process is working or not. Right, so that's your retrospective review. You have to go and consider that in terms of your risk assessment for the current year's accounting estimates. Further, you also need to consider the team that you have, your audit team, whether you need specialized skills or knowledge in terms of helping you to audit this estimate. Right, some examples maybe in terms of the valuation. So maybe the client has an investment property and you can't actually do the valuation yourself. Now, the likelihood is that the client might have gotten a formal valuer in, a qualified valuer in, and you can just look at their report. But if they didn't and you aren't sure, then you might need to get specialized skills in. It might be that you need someone to help you with the expected credit loss model, and then you might bring in that specialized skills, that specialized knowledge to help you with that. Okay. It will vary depending on the entity, depending on the industry, depending on the type of estimate that you are looking at. Further, in terms of identifying and assessing the risk of material misstatement, we mentioned this earlier on, that you must, the standard says the auditor shall do a separate assessment of inherent risk and control risk for this accounting estimate, and in terms of getting to your risk of material misstatement. So first of all, the requirements for the inherent risk assessment. The standard says you must evaluate the degree of estimation uncertainty involved in getting to this estimate, and you also need to consider the degree to which complexity, subjectivity, and a few other inherent risk factors affect, first of all, the selection and the application of the client's methods, assumptions, and data. Okay, so you can use the right data, but if your method is wrong, or if you are applying it incorrectly, then you will still get to the wrong answer. And then also in terms of management actually going and selecting the right point in determining what the relevant or the correct or the complete disclosures would be, you need to consider the complexity, the subjectivity, and other inherent risk factors in that regard. What this standard brings in is a so-called spectrum of inherent risk. Now, this concept was included to facilitate a greater consistency in identifying and assessing the risk of material misstatement. You may already have heard of this from the ISA 315 revision project, where we had an exposure draft for ISA 315, and there they also referred to the spectrum of inherent risk. But even before that, certain documents, certain guidance already kind of referred to this kind of thing. So it's not a brand new concept. So this concept of the spectrum of inherent risk takes into account the fact that for assessing the inherent risk, we need to consider the degree in which these inherent factors affect the likelihood of a misstatement or a material misstatement, as well as the magnitude of the misstatement. So these two elements or factors that we are considering is basically then placed on a graph, and there will be various outcomes that we can have on this so-called spectrum of inherent risk. Now let's look at it visually. So this picture comes from the exposure draft in ISA 315 that was released in August 2018, and you can clearly see on the x-axis we've got the likelihood for a material misstatement to occur, and on the y-axis we have the magnitude of a potential misstatement. And all the different stars are indicating possible spots of the inherent risk. So obviously you can see if I've got a higher likelihood but a lower magnitude, I'll be more towards the bottom right hand side, and so you can go on. Now the standard then goes on to say the terms, the values, the categories that you allocate to this is not prescriptive, and every firm can develop their own audit methodology. The bottom of our slide you'll see the low, medium, high. You could have categories of 1 to 10 or anything that you want to come up with. But basically this is just driving the fact that there can be various different levels at which you can assess inherent risk. So this is just important to bear in mind, that as we take into account the inherent risk factors and how each of these will contribute towards the likelihood and the magnitude of a misstatement, that we need to bear this in mind when we get to our assessment of inherent risk. Then another point to remember is that there are various factors that will influence inherent risk assessment. I've mentioned estimation, uncertainty, complexity, subjectivity. The standard ISA 540 revised has an appendix 1 that then actually expands on these factors to explain how they can affect inherent risk. So I want to encourage you to actually have a look at appendix 1 for guidance in terms of how to do the risk assessment in that regard. Another point that we need to consider, we've mentioned it before, but now the standard then comes in specifically and says, in coming to a conclusion about your inherent risk assessment, you have to be on the lookout for your indicators of management bias. So you've got to review the judgments, the decisions that management has made for possible indicators. Now, if there are those indicators, what must you do? The standard says the auditor then has to basically consider how this affects your risk assessment, but more so how it affects your related responses. Remember, when you develop your responses to your risk assessment, you have to bear in mind the reasons for your risk assessment so that you can develop appropriate responses. And obviously, a management bias will influence how or why you go and test something. You also need to consider the implication for the rest of the audit. So I'm auditing estimate 1 year, but now I've identified this indicator of management bias. How will it affect the other estimates that I'm going to audit, and more so the rest of my audit file, when I know that management is trying to achieve a certain profit target? I've identified it in auditing this one estimate. It can definitely affect the rest of the estimates and all other work in the rest of my audit file. And then at the end of the day, when I consider whether financial statements are as a whole free of material misstatement, again, consider that indicator of management bias when I'm coming to that conclusion, when I'm considering that. All right, so remember that also you'll often not identify the management bias at account, or even for that matter at the assertion level. Very often you need to stand back and you need to look at a group of estimates before you can often see then almost like a trend. So many of the examples in the standard is actually saying that you might not necessarily see in this one estimate, hang on, management clearly went for the top one in the range because they are X, Y, Z. But if you stand back and you look at a bunch of assumptions related to one or more estimates, or at a group of estimates, you can often then see that there's this trend where every time where there was a range that management has to select a point estimate for, they always went for the one that was most favorable to the company, or that was helping them achieve that profit target, or something like that. So that could then show you, hang on, there is an indicator of management bias, and therefore I now need to go and consider the effect on the risk assessment, the risk response, the rest of the audit, and so forth. So what are some of these examples of indicators of management bias? First of all, the subjective assessment that there's a change required in the accounting estimate, in the model used, in the assumptions in the data. So it's not clearly indicative because the accounting policy changed or the economy actually changed. They just decide this year, out of the blue, subjectively, that they want to change the model use. They want to have a different assumption this year. They want to change something, and nothing necessarily led to that change. Okay, it's just an example of an indicator. It is by no means saying now management is committing fraud. All right, remember we said earlier on, indicators of management bias can be either intentional bias or unintentional bias, and it does not necessarily lead to material misstatement. So first of all, then, that subjective assessment in the change required. Secondly, when they are selecting significant assumptions, almost like those point estimates, always choosing the one that will favor management's objectives, that will be to their most benefit. That one, and then also when they are selecting those point estimates, almost always indicating a pattern of optimism, a pattern of pessimism. You can see these trend type things that will be indicated management bias or possible management bias. What you also need to remember is that ISO 240, so the fraud standard, does say that you need to consider whether the management bias may represent a material misstatement due to fraud. So yes, from a fraud consideration, we need to consider whether this is indicative of fraud, but it does not mean that I conclude, yes, fraud, and that's the end of the story, and now you go off on a tangent. Another point in terms of assessing risk of material misstatement, the standard says that once we have then concluded on this inherent risk assessment, we need to determine whether any of those identified and assessed risks are significant risks. And when it is a significant risk, again, same requirements as the rest of the standards. When you've identified a significant risk of material misstatement for an accounting estimate, what do you have to do? You then have to go and identify control activities relevant to or mitigating that significant risk. All right, so once again, nothing new or out of the ordinary, but you have to go and identify significant risks and then go and identify those control activities. We'll see what we do with them just now. Another thing about the significant risks, something that stood out for me from this new standard. In the past, the extant standard said that when the accounting estimate has a high estimation uncertainty, then we go and assess if it's a significant risk. The new or revised standard says you identify whether any of those are significant risks. So the high estimation uncertainty is no longer necessary. I would imagine you can have a significant risk due to complexity, subjectivity, or any of the other factors that affected the inherent risk assessment. Then we get to the assessment of control risk, which is now separate to the inherent risk. So first of all, the standard, again, in line with other standards, says you've got to understand internal control. As a reminder there, just remember that for accounting estimates, we have 6 elements to consider in terms of internal control. So I understand those, or I consider those 6 elements, and I get an understanding of internal control around accounting estimates. I identify then controls that are relevant to the audit of these accounting estimates. Per estimate, you go along and you identify those controls. For the significant risks, please remember the standard said, and we looked at that slide just now, when I've identified a significant risk, I must go and identify the controls relevant to that risk that will mitigate that risk, and go and understand the design as well as the implementation of those controls. And that is what the next slide then basically gets to. For those controls that we consider relevant to the audit, we evaluate the design of those controls. In other words, with what management says that they are doing to address this risk in terms of this control activity. Will it prevent material misstatement, or if it does happen, will it detect and correct material misstatement? If it will not achieve that, then there is a chance that these controls are not properly designed, and I may not be able to then carry on testing them and relying on those controls. That's the first thing. The second thing that I have to do for these relevant controls is that I have to test whether these controls have been implemented. In my mind's eye, I always see this factory where the office is very high up in this factory building, there where there's maybe lots of aircon and very comfortable, and this boss sits up there and he thinks of all these controls and he just sends these controls and these instructions downstairs to the factory. But the staff actually doing the work is thinking, heck no, that's too much work, I'm not going to do that. So it's great to have properly designed controls, but you've got to check if they've actually been implemented on the ground. All right, so those are the 2 controls that we have to do for all controls that are considered relevant to the audit. We've then assessed our risk of material misstatement, and we then need to get to a point where we are responding to those risks of material misstatement. And this is now where we can go back to our flowchart again, and we can think of that, and where we then have those 3 approaches in terms of how we are going to respond to them. We mentioned and we had a quick look at the 3 revised options earlier, so you may want to also just have a look at that flowchart in terms of the 3 testing approaches to see how that fits in with us. Okay, we don't have to look at the framework itself now. I'm going to just stick with the slides, but you can obviously follow in the framework and the slides as we carry on. So the 3 options then. First of all, obtaining evidence from events occurring up to the date of the auditor's report. Secondly, testing how management made that estimate and the data on which that is based. Or a third option is to develop the auditor's point estimate or range and then assess the reasonability of management's assessment based on our own calculation. You've got these 3 options, right? You can choose one of them to get sufficient appropriate audit evidence, or you can use a combination of them. My feeling is that very often we may actually be forced or inclined to get to a second approach to really then get to a combination to get that sufficient appropriate audit evidence. Right. What's different to the extant standard? The extant standard had 4 approaches, and the 4th one was testing controls. So the standard has really now just said, hang on, control testing is a separate part that we need to consider sometimes in any case, or sometimes it won't help or won't work, but in terms of our, let's call it substantive responses, these 3 are then our options. So in addition to the 3 standard approaches in terms of significant risk requirements, we've mentioned that we need to obtain an understanding of the controls relevant to that risk. But then the standard says that if we choose only to do substantive procedures, probably then one of those 3 approaches that we mentioned just now, we have to include test of details. You can't just do analytical, substantive analytical review. What would some of those examples be? Well, it would be examining contracts to corroborate the terms and the assumptions that management has included in getting to their estimate. It could be recalculation to verify the mathematical accuracy of the model. It could be agreeing assumptions to external or other data, third-party published information by any chance? So that's actual test of detail and not just having a quick look at events after year end or something like that. Then if we look at control, internal control, and our response to this risk assessment, we've gotten to the point where we said understanding internal control. We've looked at where must I go and test design and implementation for all relevant controls. In terms of my response to assess risk of material misstatement, the testing of the operating effectiveness, or as we often say, test of controls, only has to happen when I included in my risk of material misstatement an expectation that controls will be operating effectively. In other words, I want to rely on controls working in getting sufficient appropriate audit evidence. Well, then I have to go and test that they are actually working. Or then secondly, where I conclude that substantive procedures alone will not be sufficient to get sufficient appropriate audit evidence. Well, then what is your alternative? Then you have to test controls. So from those relevant controls, hopefully they are properly designed and implemented, you then go and test those controls for operating efficiency so that you can assess your control risk as less than maximum or high if you want. Having then performed your control test, we then get back to those three approaches. And let's look at the first approach, the evidence from events occurring up to the date of the audit report, or your subsequent events if you then want. Now, first of all, before we get into the actual auditing of this estimate, remember that the standard around subsequent events is applicable regardless of which approach you take. So you'll still do your normal work in terms of identifying if there are any subsequent events, if so, are they adjustable or not. That stuff is still applicable. So just if you don't choose this doesn't mean that doesn't happen at all. But let's say we take this as the approach. When will this type of approach be applicable or appropriate? And it really is where the events are expected to occur to confirm or contradict the accounting estimate. The best example is your receipts from debtors after year end in terms of confirming whether your provision for doubtful debt is appropriate or not. But we always go and look at what payments were received from the bank account, etc. So that is probably the best example. Of course, inventory, net realizable value of inventory, confirming that the inventory is actually at the lower of cost or net realizable value, or then maybe even contradicting it and showing, but hang on, you can't actually sell this inventory for cost anymore. You have to actually sell it at a reduced price, and therefore your estimate was not appropriate. It's unlikely that this events after year end will actually be able to be applied where we're looking at things over a longer period that is not already concluded at the audit report date. And there your examples are provisions for rehabilitation, things that happen over a number of years. You obviously then can't just look at what happened in the 3, 4, 5, 6 months after year end to conclude on the accuracy, the reasonability of the estimate at year end. The other item is, of course, we'll be looking at fair value. Fair value needs to be determined at balance sheet date. So considering what happens after balance sheet date, let's say the price of the shares or the price of the whatever drops after year end, well then you can't say the share-based payment estimate is incorrectly accounted for because the fair value dropped after year end. Right, so you've got to just take that very carefully into account. But where it is confirming information about that estimate, that is definitely very helpful in that regard. The second approach is then available in terms of testing management's actual own estimate. Now remember that you can very often use this one in combination with, let's say we do this for the inventory, and actually in combination with testing events after year end, the first approach. Or what we'll also see later on is if I test the management estimate and I get to a point where I'm saying management is wrong or management didn't do it and they don't want to do it, well, what's your alternative? You have to then go and do your own estimate to supplement your evidence in terms of determining what actually needs to happen. So it's not necessarily just only done in isolation, although it can be done in isolation if that will give you sufficient appropriate evidence. So what are we saying? When can we do this? Well, it's appropriate when there are similarly accounting estimates made in the prior year, and those estimates are suggesting that management's processes is still appropriate. So where would we get this from? Well, from our review of the prior year estimates outcomes and saying management seem to have gotten it right in terms of how they calculate for inventory obsolescence, in terms of how they calculate whatever, and so therefore we're going to test that management did it right again this year. Or if it is based on a large population of items of a similar nature that are not individually significant. So it doesn't make sense for me to go and test each one individually. I'll rather go and look at how did management come to this and go on that. Inventory calculation, probably a good example in that regard. And then, of course, when the applicable financial reporting framework specifies exactly how management is expected to make that estimate, there your expected credit loss model or fair value estimations very carefully then can actually help you with determining this is what the framework says. Has management done this? You can't necessarily then go and develop your own model or anything if the framework is already prescribing the stuff. Good examples here, fair value estimate developed in terms of a model, using management's model, or share-based payments, where you're considering everything that management has taken into account. Right, what else do we need to consider here? We have to do quite a bunch of work on basically everything that goes into this estimate. You can see this whole long list. When you get to this, it might be worth going and actually having a look at what the paragraphs are actually asking you. It really is a long list of things to do. But let's run through these bullets and see what becomes appropriate. So first of all, the standard has specific requirements for the application of the methods, the significant assumptions, and the data. But they can basically be summarized and checking that when management selected these and when they applied the methods, assumptions, and the data, that they were appropriate in the context of the framework. Remember? Management had to apply the accounting framework in drafting financials. We need to check that they did that correctly. We need to check that should there have been changes from the prior, that they had applied those, or if they decided to make changes, did they actually make them appropriately? Right, so remember we started off with saying this could very well be appropriate where management's process from last year seemed to be working. So if they then changed their process, check that it was done correctly. Where judgments were made and they give rise to management bias, well, we need to go and check whether those are indicators of management bias, whether they were not maybe leading to intentional misstatement, whether they weren't maybe indicative of fraud. Go and then test that bias or the impact of the bias. Calculations need to be mathematically accurate, so you've got to go and check those things. And then where there's complex modeling, there's a whole bunch of things around that. Of course, the judgments made in consistently applying that model. Even this, just the design of that model and checking that that was appropriate, that it again meets the requirements of the framework, that perhaps have to change. And if so, was it changed appropriately? Any adjustments and stuff that need to be in line with the requirements of the framework. And then, of course, the integrity of any significant assumptions and data, that integrity has been maintained. So integrity in terms of getting the stuff from the system, how do I actually manipulate this information? Does the information or the data, is it still complete? Has it not maybe been modified? Has someone not maybe removed a formula somewhere? All of that around the integrity of the information that goes into this model. All right, then in terms of the assumptions, those assumptions again need to be consistent with each other in that same accounting estimate in terms of comparing them to other estimates and even just assumptions generally in the file. We need to also make sure that where management has made these assumptions, that they actually have the intent to carry out on these assumptions and of course the ability. They may want to do this or that or whatever, but actually don't have the money to do it or don't have a choice but have to sell this or that. So we've got to go and check that those assumptions are realistic in terms of management's intent and ability. If we then get to the data, we talked about the integrity of the data, but also just to make sure that the information is reliable and also relevant to the circumstance. All right. This is where we may need to have quite frank discussions with management to say, how did you choose that method? Why did you choose that method? Why did you decide to change this? Where are the assumptions? Why did you not consider other assumptions? Have you considered other assumptions? And how did you decide on these assumptions as opposed to, did you do a sensitivity analysis? Why not? So really frank discussions and possibly then that, remember that professional skepticism discussion we had where we said, possibly needing to actually challenge management to say, but guys, how did you actually get to this? Was this really the only or the most appropriate value to get to? Okay, not easy to do, but definitely necessary. And again, I want to reiterate, the extent of work required will depend on the level of complexity, the subjectivity, etc. that's involved. There may not be such significant assumptions or so much complexity involved in management's estimate, but there may just as well be. So I would imagine, the bare minimum is checking the mathematical accuracy of the estimates calculation. When we look at the case study, we'll talk more about how and where and what can you consider. But it really is important that we really get evidence around all of these items to where they are relevant. Further audit procedures also addresses management's selection of the actual point. So it actually just carries on and saying, well, has management taken the steps in terms of understanding estimation uncertainty? Have they considered, listen, are there any assumptions? Why are we choosing this assumption? Disclosures. Have they really carefully explained to the user of the financial statements the uncertainty around this estimate or around the amount of the estimate? Well, yes, again, it may be higher estimate uncertainty, then we need to display or disclose and explain it in more detail. It may be lower estimation uncertainty, and then you may not need so much. But we really need to apply our mouths and see that the correct level of detail has been disclosed, that management has actually applied themselves to this. Then when management has not taken the appropriate steps to understand this, what must the auditor do? Well, there's your 3 steps. You must request management to perform additional procedures so that they can understand it. Probably an easy example is with regards to the residual value or the useful lives of property, plant and equipment. If management is not considered, listen, is 3 years, 4 years, 5 years, 6 years the appropriate useful life? And with that, then what is the residual value linked to that? If they haven't actually considered, well, in the past we used 3, but maybe it's now going to become 6. If they haven't applied their mind to that uncertainty, well, then your whole estimate can actually be wrong. So you have to ask management to consider that uncertainty. And if not, well, then you've got to go to the next steps. And this year, I actually just see a big stop sign in my mind. If management refuses to go and perform additional procedures, you have no choice but to basically stop option 2. You can't then continue with testing how management made the estimate because you now know that they didn't do everything they had to, and you must then go to option 3, which is where which is where the auditor then goes and calculates its own estimate or its own range of estimates to go and evaluate management's estimate that they decided on. Right, so if they really don't want to go with calculating or considering estimation uncertainty, you have to go and consider your own estimate, your own calculation. You also have to go and evaluate whether all of this around the uncertainty, estimation uncertainty, actually then indicates a deficiency in internal control, and if so, communicate that to those charged with governance. Got a slide just shortly on those charged with governance and the communication in that regard. But the standard now expressly says that where management does not take the necessary steps to address the estimation uncertainty, does this indicate a deficiency in internal control, and what are our responsibilities to communicate that to those charged with governance? Then our last option, developing your auditor's point estimate. Now, in some instances, especially in terms of auditing smaller and medium enterprises, the client might have actually not applied their mind properly, like we had now with the second option. Management's estimate, they did something, sucked it, we can clearly see the assumptions is incorrect. And so then we may not have any choice but to go and calculate our own estimate and go and see how far they were wrong, basically. But there may also be other instances where this may make more sense for us to just go and do our own thing and then compare it. So it's not always your first point of call, but it could be. When will this be appropriate? Well, when similar accounting estimates that management made in the previous year clearly shows that their process is not working. So we're not expecting that process to be effective, to work, to give us the right answer in terms of the accounting estimate this year. Or when controls of a management's process is not well designed and implemented, and so therefore we don't actually expect the controls to work, and therefore don't really trust what is going to come out of management's process. So never mind having evidence that it's not working, we're just unsure. And then management's point estimate that contradicts events that we've got elsewhere. So subsequent events show something different, yet management's assumptions is sticking to their guns and they don't want to change, even though subsequent events is showing something clearly different. Yeah, I can't help but think about payments received from trade receivables, or they're not received from trade receivables, and it's already been 6 months after year end and we're still not getting anything from it. Well, then maybe we need to say to management, if you won't consider estimation uncertainty, if you won't amend your assumptions, then we're going to go and calculate what this seems to be, what our assumptions seem to be required, and what the output or the outcome of that estimate is going to be. So you can clearly then see some examples on the slide, in addition to what I've already mentioned, being those useful lives and the residual values, where the client just hasn't applied their mind at all. Impairment of goodwill, where they don't want to impair the goodwill and you believe that the framework no longer indicates that this can just be amortized, if it is amortized, or just reflected as is, and that you actually need to now go and impair it. And then you may need to go and do your own assumptions, get your own data, and apply your own model to determine what the impairment should or may need to be. Right, so what are the requirements in terms of the standard for applying or coming up with your own estimate or your range? So the standard says you must include the procedures to evaluate the methods, the assumptions, and the data that is appropriate in terms of the framework. So we mentioned them earlier as well, in terms of considering the methods and the assumptions and the data that will be applicable here. We've got to go and consider significant assumptions, significant data. Now, maybe just to stop here and just to say, you don't have to go and recalculate your complete point estimates. Yes, of course, if the auditor wants to just completely leave what management has done to aside and start everything from scratch, and do that by all means. But the standard does allow the auditor to say, well, management has used model X and they've come to these, and that's the significant assumption that I'm not happy with. They can then go and just basically go and re-estimate that portion, that part of the estimate, and go and plug it into management's thing and basically get to the result. So you may only need to consider the parts, but where relevant, consider those methods, significant assumptions, and data, where they come from, should they have been changed, has the judgments been done correctly, and so forth. In your own range, you must then determine a range that includes only amounts that are supported by sufficient appropriate audit evidence and reasonable in the context of this framework. So you can't just go and just calculate, these ones and then, just include something else. Basically, the standard thing goes in the application material and says if the top point in your range and the bottom point in your range, if you've got sufficient appropriate evidence for those two, then it's assumed that the rest of the items in the middle is also appropriate. That's then your range that you go and compare or evaluate management's estimate for reasonability. The auditor must also perform procedures to address the disclosures in the financials and to make sure that the disclosures in the financials are reasonable, and specifically then also describing estimation uncertainty. So just because you are now developing your own estimate doesn't mean you don't have to focus on disclosures. We all know that disclosures are very, very important, and that there's a significant focus by the auditor on that. So please don't forget that other element in that regard as well. Then the auditor must, of course, comply with all the evidence requirements, the ISA 500 requirements. So if we think about experts, assertions, and so everything about evidence, selecting items, etc., you have to comply with ISA 500. In terms of the management expert, there's certain of the requirements from 540 can assist you in evaluating the appropriateness of the expert's work. So there's a lot of mention of management experts in 540. Of course, still the normal standard requirements of experts apply, but you can help or 540 can help you to determine how to evaluate that information. And then another point to consider is that where the client uses service organizations, ISA 402 can assist you in complying with some of these requirements around 540, the revised standard. We've already mentioned obtaining evidence about disclosures a number of times, but it is really, really important. So let's just look again at the explicit requirements in the standard's main requirements. So they say you've got to get sufficient, appropriate audit evidence about disclosure. So sufficiency, remember, always enough. Appropriate, correct relevance, correct nature, etc., in terms of the disclosure, sufficient to address the risk of material misstatement that you assessed for the assertion level disclosure risk of material misstatement. And you must also get that around disclosures other than estimation uncertainty. So we've mentioned disclosures around estimation uncertainty, but there are other disclosures, and you have to address the risk of material misstatement of those disclosures being incorrect as well. So what does the financial reporting framework require? Well, of course, if fair presentation needs to be achieved, you've got to consider whether the disclosure is sufficient to achieve fair presentation. That the disclosure should not be misleading if you consider a compliance framework. And also that the disclosures may actually need to have more than just what the framework requires to achieve the fair presentation or not be misleading, or give the user all the information to make it reasonable, that they will understand what the accounting estimate requires or what entails, and everything that management considered in getting to this amount. Then the overall evaluation, or as we generally refer to as the stand back provision. Despite all the requirements and everything that we've mentioned, it is still possible that the auditor may have forgotten about something here or there. So the standard says that at the end or somewhere along the line, probably towards the end before you move on, you have to consider, you have to evaluate whether the assessment of your risk of material misstatement at a certain level is still appropriate. You started off, you said high, medium, low, 1, 2, 3, 10, whatever. You did your work, you've obviously learned more about this estimate. So just stand back, just think, yes, am I still happy with this before I move on? You have to evaluate whether management's decisions relating to the recognition, the measurement, the presentation, disclosure, those requirements in terms of the financial reporting framework, have their decisions been in accordance with the framework? So they didn't go and actually contradict or contravene those requirements. Do you have sufficient appropriate audit evidence about this accounting estimate to conclude that it is reasonable, that the disclosures are reasonable? And then if you haven't got enough audit evidence, well, then I'm guessing you're going to have to go do more work until you can evaluate and conclude that you have sufficient appropriate audit evidence. Of course, if you are unable to conclude on that, you have to evaluate the implications for your audit opinion, right? In terms of, are you now going to have to qualify, maybe give an adverse opinion or whatever. Further, you also need to determine whether the accounting estimates as well as those related disclosures are reasonable in the context of the framework, or if they are not reasonable, well, your other option is really it's got to be misstated. So the evidence that you need to get in the following scenarios is probably going to indicate to you that you have a misstatement. If you've done your estimate, so the auditor has done an estimate and management has an estimate, well, then the difference between the 2 points are clearly the potential misstatement. If management has a point estimate and the auditor has done a range of estimates and management's point estimate falls outside, well, then the difference will be the misstatement will then be the difference between management's estimate and the closest point to the auditor's range. Right, so let's say it's above the higher end, you'll take the higher end of the auditor's range, and the management misstatement, and the difference between those two will be the misstatement that you're going to go and consider. The standard has specific requirements in terms of the written representations, and I certainly think that it is worth it to go and look at the detail included in here so that you don't fall short in the representation letter that you get from your client. So the standard requires written representation whether the methods, the significant assumptions and the data used in making these estimates are appropriate, obviously in terms of management's assessment, to achieve the following in accordance with the framework: the recognition requirements or the recognition criteria, the measurement criteria, as well as the disclosure requirements. Right, so basically management needs to say, yes, we've applied the framework, our methods, significant assumptions and data are appropriate. And those are also the 3 categories where there was that lots and lots of work when we estimated or where we tested management's estimate. Most of the work went into the methods, significant assumptions and the data. So this is just to top it up, to polish it off. And then we can also consider obtaining specific representations about specific estimates or details about the estimates, but that then being, I almost want to say, the bare minimum of what we need to get. For specific estimates, some examples may be significant judgments that have been made, that's been taking into account all the information available to management, that the management processes are consistent and appropriate in the circumstances, management's intent and ability reflected in the assumptions, in the models, etc. And then also in terms of disclosures, of course, the completeness and the reasonability. coming back to the framework, in context of the framework, what does the framework require? Is the disclosure complete? Is it reasonable? Management representation in that regard. And then, of course, management saying that they've applied the appropriate specialized skills and knowledge. That doesn't mean management has to have the necessary or the specialized skills or knowledge, but do they believe that they have used the correct or the appropriate skills and knowledge where necessary? Obviously, then probably leading to a management expert. Then another example could also be that management explicitly represents that no subsequent events require any adjustments to these accounting estimates. You'll see that many of these things aren't new or funny or weird things, but maybe just to include them for extra comfort. Where management concludes that certain estimates are not recognized or not disclosed, you need to also, or the standard suggests that you also get representation from management that the basis that they use to determine that the estimate does not have to be recognized or that there's no requirement for disclosure, the criteria for disclosure is not met, that their basis to conclude on that was actually done appropriately or that they made the appropriate decision. Again, not required as such, but a suggested representation, really just to polish up all your evidence and make sure that everything talks to each other. We then get to a new part in the new standard 540 revised, but certainly nothing new from the standards in terms of communication to those charged with governance. So the standard says that even in auditing accounting estimates, the auditor has to consider what or whether there's any information that should be communicated to those charged with governance, to management, and even other relevant parties as appropriate. In this regard, then mentioning possible regulators, like a bank's regulator or the insurance company regulators, those kind of guys. So in terms of the types of clients that many of our smaller and medium practitioners will come across, probably considering these elements, in terms of communicating them with management if you haven't already done so, and then possibly even including them in your management report to those charged with governance, to the directors. And things then to include or to communicate to management is potentially items of subjectivity, significant deficiencies in internal control, and remember internal control includes all those elements, not just the control activities, very high estimation uncertainties, potentially communicating that, the reasons for risks of material misstatement, qualitative aspects, and then also certain complexities that you've come across, potentially including that in your communication to those charged with governance, if necessary. The standard also refers, and here again your example probably with regards to expected credit losses, where certain regulators may actually want to hear from the auditors in terms of where they found it very difficult to audit or where they couldn't find information, etc. So again, probably more unique circumstances, but that would be the example of communicating to other relevant parties or regulators in this regard. And then that brings us to the documentation requirements. Now, I wouldn't say that there's more documentation required as such, but that there's definitely more explicit requirement for the documentation. Remember, ISO 230 documentation still applies. You still need to have sufficient documentation so that another experienced auditor can understand what you did and come to the same conclusion. But the standard now just has more explicit requirements. You have to document the key elements of your understanding of the entity, the environment, the internal controls relating to these estimates. I think this may be where we're going to have to beef up some of our documentation if I think about what I've seen in audit files. You have to make sure that there's a very clear link between your audit response and the risk of material misstatement. What is the requirement there? Very clearly linking the reason for your risk of material misstatement to your response. So just making sure that why is there a high risk of material misstatement? Maybe it was complex, maybe it was subjective or whatnot, and then adjusting your response to that. So if it was subjective, then I need to go and look at the reasons more carefully, apply more professional skepticism. If it was complex, well, do I maybe need to get someone with specialized skills or expert knowledge? Not necessarily, but going and looking at that. And of course then, just making sure that your documentation links the response to that assessed risk of material misstatement. Then documenting the auditor's response when management has not taken the appropriate steps with regards to the estimation uncertainty. documenting the indicators of possible management bias, and of course the auditor's evaluation of those implications. And there's those 3 questions, so make sure that you document that. Implication on the rest of the audit, implication on whether the financial statements is free of material misstatement, and how you're going to actually then react to that in the rest of the audit. And then significant judgments, documenting how you determined whether those estimates and their related disclosures are reasonable in the context of the framework, and your significant judgments that you made in concluding that. Okay. Of course, ISA 230, all the normal documentation requirements still in place, but these points then very specific or explicitly mentioned and required. Before we say goodbye and end off, I want to just remind you that many of our elements then actually links back to the IFAC implementation support, specifically those 2 flowcharts, and therefore just our copyright statement to remind you that those documents are copyrighted. If you want to use it or if you need to use it, please also contact IFAC for permission, just so that they are aware of it. That has brought us to the end of today's session. I thank you for listening to this session. I believe that you got a lot out of it. I want to encourage you to go and look at the standard, maybe not the whole standard, but to the certain elements that you want to. Remember, there's a lot of application material, so there is a lot that we just couldn't mention that I will definitely apply in the case study. I look forward to guiding you through the case study and assisting you in that regard as well. Thank you, and have a good rest of the day.